Welcome, 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 everyone. So happy to have you here. Going to do a little experimentation today, try something new for the channel. And instead of doing the traditional live stream style where I'm just kind of sitting here telling you what's happening with the market, instead, let's just hang out. Let's just watch what the market is doing, how it's reacting to this Fed news, and just have some fun. Something a little different for the channel here. Those minutes should be coming out in a minute. I'll pop up the old Financial Juice. And as these things, if you're unfamiliar with Financial Juice, it's just a good site for, super fast updated financial news. So we should start seeing some things pop up here, what they're talking about in those notes. We'll watch how the market reacts to that and wait for Papa Powell to speak, and then we'll listen to him. So thank you guys for joining me. Let's see how this goes. As of now, the market is rotational in a very tight range, as is to be expected, what with everyone waiting for this FOMC news to come out. All right, those notes obviously just dropped. Okay, interest rates were spot on. So we were just talking about on the private stream how oftentimes, or at least the last few times that we've had an FOMC meeting, it's made a move one direction and then reversed and trended the other direction, and for the rest of the time. So we're watching for that potentially here today. A new subscriber. Welcome, football boy. Football, are we talking American football or international? Ooh, that sweet, sweet volatility. That tempo, that speed. That FOMC day chaos. I love it. Well, that doesn't tell us anything. It would be appropriate to raise rates soon. Of course it would. RK saying he bought some puts as a hedge. Nor Auto Trader, try to trade on Sim. Actually, that's a great idea. If you're newer to trading, I would not try to take trades right now. The volatility will make you feel like you'll feel FOMO. You'll be watching it move, higher and higher and higher. And you'll be like, I got to trade it. But it can reverse very quickly. So only for experienced traders. Oh boy, they're coming in hot and fast. Here we go. Calling for March to be the end of bond buying. Doesn't seem like they're speeding anything up. Okay, so that initial move, that initial push was up. So now we're going to see, do we retrace the day's range and start heading lower? Or do we find some support in here and then push up again? Remember, the last few times it's faked us out, but it doesn't always do the same thing. So it's a question of support now. Can we find support inside this value area? Or do we start to trade lower? If we do, I bet we have some downside continuation. Ooh, that tempo. Pirate traders, are you trading the news? I am, but I certainly don't know what to do yet. Generally on these days, I'm just taking really quick little trades once I feel like it has a direction. So like, let's say I think it's going to go long. I was just like, buy, take profits, buy, take profits, like buy, take profit, just like constantly in and out, in and out, in and out, rather than just sitting in it. Just because the tempo, I emotionally can't take it. Design knob, look at the NQ if you want to see some tempo. Very thin volume though, still very thin. But yeah, it's just bouncing around by 30 points at a time. No big deal. Ooh, here we go. This is interesting. We are ready to change any details on the balance sheet reduction in light of economic and financial developments. We'll see how the street takes to that. Football boy, is there a way to watch the meeting live? Well, you can't watch it while it's happening live. It actually happens over a couple of days, but it's super top secret. It's like they put your cell phone in a metal box kind of secret. But they will have the federal chairman, the chairman of the Federal Reserve will come out and testify here in about 25 minutes. And I will be playing it here on this stream. So you can go watch it on your own on YouTube, or you can watch it with my commentary. Life's amazing. Another new sub, Victor. Welcome. Happy to have you. Hans. Definitely bringing in some new people today. What do you trade? Are you a good trader? Well, I don't know if I'm a good trader. I survive. I make a living. I trade the ES mostly, or the MES. I'm a day trader. So I take, short-term, very short-term trades. And the software that you're looking at here on screen is called Market Profile. It's the same thing as candlesticks. Each one of these letters represents a 30-minute time period. But the profile just displays it in 3 dimensions that allows me to see not only what prices the market is going to, but how much time it's spending at each price. So I can see at each level, based on the number of letters there are, the more letters, the more time it's spent there. And then over here on the left, this is the volume profile. So the bigger the candles and the darker, the more volume there. Livis. No need to watch the market live. Just find out what the Fed members are doing. No, they can't do that anymore. They just came out with like strict rules for them now. They're not allowed to do any trading. Thank you, Jay Trader. Yes, everyone, please push that like button. It really helps the channel, helps bring in some new people, some fresh blood. David V. Charles, is your e-course out? Not yet, brother, but thank you for the reminder. I am working on it. It shall be soon, I promise. Hans, you stream every day? Yes, sir. For the first hour of the day. This is something random and weird I'm trying for the first time. $777 Athletic. So what's the news? Is it good news? Well, so far, the only thing that really stood out as anything new to me was them saying they'd be willing to change any details on the balance sheet reduction in light of economic and financial developments. That's new. But other than that, it's all the same stuff. So it's all about just seeing how the market reacts to it now. Okay, so that initial move was to the upside, and now we test. Do we find support in this range and take another stab at it? That would be very bullish to me. But if we start to trade down below this range, that would be bearish. Because like I said, the initial move is often wrong, and they end up going the other way. So it doesn't always happen, but it could. So definitely looking for some support right in here where we are right now. Come on, buyers. We would see that by looking at the ticks, since they're all the way down near the negative 1,000 level. We would see that by them starting to push their way back up to the zero. So far, so good. Futures trader, no rate change, more taper. They will buy 50% of what they're buying now, but that was to be expected. For those of you that are new to the channel, a weak reference in market profile is created when a TPO in one of these letters comes within a single tick of another letter. And it just basically means it increases the odds slightly that the market will come back down and get a few ticks below that level. So right now we're getting that repair of that weak J-low. creating another weak J-Lo. Mark, seems like this was already baked into the current price levels. Yes, but the market not knowing what they were going to say has people hedging. And so now they have to unwind those hedges, and that could lead to some movement. Okay, so once again, the initial move was to the upside, and now we're beginning a downside move. Design knob, elevator drop. You looking for that big sell-off? Let's take a look at the Q. Q's finding support in its range as well. Same story. You break those lows, you're definitely heading lower. John L., maybe gap fill. Which gap are you referring to? One, it's called a market profile chart. Also referred to as a TPO chart, time price opportunity. A ridiculous name. Okay, we got another weak J-Lo in need of repair here. Single tick from the A period low. John L. Yeah, the real gap to yesterday's close. Sure. We judge gaps based on the previous day's high. That's why I was asking. Yeah, I mean listen. If we start to get down in there, if today's FOMC works like other days, it's just going to keep going. We're going to test yesterday's low probably, but first we got to break the support here. Start getting some long liquidation. Bearish. Bear. So I guess you're not trading this. I will trade it. I just don't see a trade yet. The market hasn't picked its direction. Right now it's still digesting, as they might say. Oh, you mean to the upside? No, I have it a bit lower. I have it at 44.35. Yeah, I mean, the NQ traded right to its previous POC from the 21st as well. So on the NQ, I start to get bearish and looking for short trades once we get below 14,372-ish, basically the end of the pink volume nodes down here. If the market starts to trade below there, I'm going to get bearish with it. And on the ES, it'll be the C period low, so 43.81. If the market gets below there, I'll start looking for short trades. So the way I do it, I don't FOMO into the short trade. I wait for it to come back, and then I sell resistance. So it like pops lower, comes back up, gets some resistance. I sell that for continuation. It's a beautiful, beautiful drawing here. Gold is moving up. Oh boy, that's a hedge. No, that's still an indecision right now. Same as the ES and NQ. They're rotating, trying to make up their mind. What if it doesn't pop back as much as you hope? Do you not get into a trade then? Correct, yeah. So if I'm trying to sell resistance, so say the market starts to trade lower and it doesn't come back up, I don't get a chance to get into the trade and it just continues lower, I don't try to chase it. I wait for the next one and then I sell that. It's all about probabilities. And you have a much better chance of being right if you sell resistance rather than trying to chase price down. Today might be an exception if we do get one of those crazy downtrends. Let me turn down that audio a little bit. If we do get one of those crazy downtrends, you might be able to just, sell into the momentum. But I'd rather sell resistance. Amir, that's amore. What are you responding to? Oh, the picture. It's amore. If you haven't yet, please smash that thumbs up button if you want the market to sell off here. Let's get some likes going for the bears. Who thinks the market's going to sell off? Smash that like. Diego, market waiting for Powell to speak? Yes, they are. Aren't we all? All right, guys, get your votes in. Let's get a little community poll happening. We making new highs. We making new lows. That's on today's range. So are we getting above the J period high, getting below the C period low, or are we going to stay stuck here for the next couple hours and bounce around? Let me know what you think with a vote. What do you consider resistance? This is a great question. So I don't look at markets with like exact levels. I used to try to do that, and it just constantly gets me stuck in a way of thinking. Like if I think they have to come down here to a certain level and they don't, I miss the trade. So I think of things now in terms of support and resistance, in terms of areas. So for example, if as the market's trading down in the L period, I'm looking for support, in my mind, I'm just looking for it to find support somewhere in here. And I don't really care where. If I'm uncertain, let's say it starts to trade to like right here and it's bouncing and I think, ooh, it looks like it's getting support, but I'm not sure. Just get in with a smaller size, only one contract, and then see if it bounces a few more times and it's still finding support. Okay, cool. Add one more. Still finding support. Starts to push up and out. Give me my money. But yeah, I don't find having exact levels helpful. All right, last chance on the poll. Gonna close it. Gonna close this poll. The results are in. I love it when we get 50-50s. New highs, 40%. Rotate, 30%. New lows, 20%. Wow, so only 25% of you see a sell-off here. That means that's what's going to happen. I'm just kidding. All right, well, the Fed chairman should be coming out here shortly. I'm going to go ahead and get that video going. And we should be able to just kind of watch the market bounce around while he talks. Okay, so at the moment, the market remains rotational. We keep coming back to that POC. Indecision City, as of now.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so. Economic activity expanded at a robust pace last year, reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected, as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would be...
All right, tempo starting to pick up here. Normally by now it would be trending a certain direction. So this might be a day where we actually just rotate. But still keeping my eye on those lows. We start breaking these lows, that liquidation break can happen, and the market gets very quick on its fall.
Levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan announced in December
here we go. We're getting down
to
there
end
the queue.
asset purchases in early March.
Will the buyers step in?
In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet.
There it is.
And we will
Saying
discuss
nothing.
these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right. Well, it looks like I was early getting
Thank
bearish
you. For the
here.
first question, we'll go to Chris.
It's still rotational. I haven't seen this on an FOMC day probably ever, at least that I can remember. So finding support is actually kind of bullish. I'm back to neutral. That's a sign that the news is already baked in. They don't need a pullback to bring in more buyers. They're getting them up here. Sorry about not answering questions. I'm trying to pay attention to the FOMC. I will get to all of those after.
Currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So, more to your question. We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Thank you. Let's go to Victoria Guida at Politico. Hi, Chair Powell. I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're at right now as maximum employment, and also along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Sorry, just getting both parts of your question written down. So I would say, and this view is widely held on the committee, that both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic. And I would say that most FOMC participants agree that labor market conditions are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability. And that is my personal view. And again, very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds rate. The other thing is maximum employment will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum of employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the policy path that we're broadly contemplating would be supportive of that outcome as well. So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market. And my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are
all right.
Are highly
Second
uncertain,
attempt at a breakout on the low
inflation
here.
has persisted longer than we thought, and of course we're prepared to use our tools to assure that higher inflation does not become entrenched.
Thank you. Let's go to Nick Timrose at the Wall Street Journal.
Good afternoon, Chair Powell. Nick Timrose at the Wall Street Journal. I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales or changes in the composition of reinvestments? Thank you.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, but And then, at the appropriate
So
time,
we're looking
we'll
for
provide
resistance
additional
around the
information.
C period low
So
here.
I did the last cycle when we went
We're
through
looking
balance
to
sheet
start
issues.
getting
We
some
did find
sellers
that
piling on.
over the course
and
of 2 or
further
3
downside
meetings, for example,
continuation.
we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to, more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter duration than the last time.
So
And the
again,
economy is
looking for
much stronger and
resistance to
inflation is
sell.
much
I
higher.
don't sell the momentum
So,
down.
and
I wait
I think
and
that
see
leads you
where does
to,
the market find
and I've
resistance
said
and
this,
sell that.
being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number 1, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate. We want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
So if I could follow on that, raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every quarter percentage point increase in your benchmark rate?
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs, I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think the pattern we'll follow is to
We don't know.
is to
He's saying
arrive
we
at
don't know.
a timing and a pace and
He's saying
composition and all those
we can't
things,
figure it out. We're so scared.
and then announce that with advance notice. And
We're up
and-
here.
and-
We're
and it
pretending
will,
we know what we're talking about, but
it will start
we
in the
have no
background,
idea.
and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
Thank you.
Thanks. Now we'll go to Neil Irwin.
Thank you, Chair Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy. Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this.
Look at the queue.
We said at our last meeting, we published a summary of economic projections, the median of which
Lots of support
the median
in here.
participant expected 3 rate increases this year. And
It'll take some
it's
real
6
grinding
weeks,
to get
7
through
weeks
all
later
this.
now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations, so that in and of itself is appropriate.
Thank you. Let's go to Howard Schneider.
For a year hi, thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements reference the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
Well, you're right. We haven't gotten to that point yet. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so. We have our eyes on the risks, particularly around the world, but we do expect some softening in the economy from Omicron, but we think that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
If I could follow, just on a related question, the December steps had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
The path is highly uncertain, and that we're committed to using our tools to make sure that high inflation that we're seeing does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will be providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
Thank you.
Thank you. Let's go to Gina Smialek. Let's go to Gina.
Gina, are you there? Hello?
Okay, let's go to Steve Leisman.
Thank you, Mr. Clinton. Thank you, Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of the technical question part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principle says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. and it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to
Somebody
describe
just did a big market order
how
somewhere.
we will
See that little
proceed.
pop?
But it may be at a higher level, to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first.
Okay, so just to comment on what I'm seeing technically here. So this is what we call a liquidation break, where all the long traders are panicking. So that's what gave us the initial fall. And now we're looking to understand, are there new sellers that are piling on now who were flat and are now going short to add more momentum to the downside? Or are we just squeezing out all those longs and bringing in new buyers at this level? And so what I'm looking for is I'm looking to see if we turn one of these candlesticks over here on the left, not the ones in the middle, but the ones over here on the left that are very thin white candlesticks. I'm wondering if we turn any of those pink. And when that happens, I'll look over at the ticks and see, are we still below the zero line? If we pull back up into range, so if we get back above this C period high, so 43.81, without having turned any of these candles pink over here on the left, or we get the ticks back above the zero line and they start to trend higher, I will assume rotation from that point and target getting back to the POC. But for now, it's still bearish until they give us one result or the other.
We will have at coming meetings.
Thank you. Let's go to Craig Torres.
Chair Powell. Chair Powell, good afternoon, Michelle and Chair Powell. Craig Torres from Bloomberg. Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing? Is Fed policy a risk, over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions. In a couple months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of things. And next to those transactions, we'll put dates. And Bloomberg asked for the dates of Mr. Kaplan's transactions. The Dallas Fed is not giving us the dates. And I don't see why this is a matter for the Inspector General or anybody else. I mean, why can't he give us the dates? Will you help us get the dates of those transactions? Thanks.
So you asked about the risks first. So the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that the high inflation we're seeing will be prolonged, and there's a risk that it will move even higher. So, and we don't think that's the base case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one where inflation remains higher. And of course, that is a risk to the expansion. We've been saying that what we need here is another long expansion, which is the kind of thing we saw over the last, which is the record long expansion. We saw labor force participation. rise. We saw wages persistently higher for people at the lower end, and there really was no obvious imbalance in the economy that threatened that expansion. It could have gone on for years were it not hit by the pandemic. So we'd love to find a way to get back to that. That's going to require price stability, and that's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. So I mentioned two-sided risks.
For those of you that are newer to the profile, when we create single prints like this, you can see how there's just these Ks. They're all by themselves inside the range here. Actually, look at that. It lines up perfectly with the single prints from overnight. That's funny. Just coincidence, doesn't mean anything. But those single prints, that is a sign that the market might need to push back up and backfill them. It's pretty rare we leave behind single prints like that at the end of the day. So it increases the odds just a little bit, not a ton, but a little bit that we'll need to push back up there and backfill those. And then we often get resistance at the base, wherever they start. So that would be that C period low, 43.80. But as of now, the momentum is still to the downside. Okay, so we're entering a zone of potential support here where we put in all that volume yesterday. So looking for some support in here, little grind to get through it. If they do, then further downside continuation. HC, I will answer that for you when the conference is over. It's a great question.
That we fully appreciate that this is a different situation. If you look back to where we were in
basically, he's just been saying, like, we don't know what we're going to do. We'll tell you later. Don't worry about it. We got it under control.
the natural rate, and growth was, in the 2 to 3% range. Right now, we have inflation running substantially above 2%, and more persistently than we would like. We have growth even in forecasts, even in the somewhat reduced forecasts for 2022. We still see growth substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. If you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's 1.5 percentage points lower than it was in February of 2020. Maybe 1 percentage point of that is retirements. Some part of those retirements are related to COVID rather than just regular retirements. So we think there is a pool of people out there who could come back into the labor force, but it's not happening very quickly, and it may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the March meeting and meetings after that.
Let's go to Rachel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can talk to us about any metrics that the Fed uses to assess how inflation affects different groups of Americans, especially lower income earners. And are you worried that the Fed underestimates or can't effectively measure the impact of inflation on some of the most vulnerable households? Thank you.
So it's more a matter of I think the problem that we're talking about here is really that people are on fixed incomes who are living paycheck to paycheck. They're spending most or all of what they're earning on food, gasoline.
Okay, so we're
rent,
testing the very bottom of this support
heating,
right
things
here.
like that, basic necessities, and
not bringing in a ton of buyers.
Inflation right away forces people like that to make very difficult decisions. So that's really the point. I'm not aware of inflation literally falling more on different socioeconomic groups. That's not the point. The point is some people are just really prone to suffer more. I mean, for people who are economically well off, inflation isn't good. It's bad. A high inflation is bad, but they're going to be able to continue to eat and keep their homes and drive their cars and things like that. It's more so that's really how I think of it. And we have to control inflation for the benefit of all Americans, but part of it is just that it's particularly hard on people with fixed incomes and low incomes who spend most of their
same thing with the Q. It's testing the very bottom of the support. This is the last support we have,
which are experiencing high inflation.
If the lows break again, we're looking for another push lower.
Thank you. Let's go to Edward Lawrence.
Thanks, Michelle, and thank you, Mr. Chairman, for taking the question here. So year over year, inflation's at a 40-year high. The input costs for producer price index for all of 2021 was the highest on record. Some investors fear that the Fed might be moving too late. Now, you said no decisions were made on the path of rate hikes, but was a rate hike more than 25 basis points discussed today? And as a follow to that, because I have problems with the mute button, as a follow to that, you testified that the supply chain issues could be worked out by the end of the year. You talked about that today. The CEO of Ford, though, told Fox Business today that the chip shortage will last into 2023. So today you said inflation will start to ease this year. I want to drill down and get a timeline that you see as to when we could see that relief. Thank you.
All right, tick's getting above the zero line.
I would not say
that's the first signal that we might be finding support here.
To be completely
now
worked
let's see
out
if they
by the
can
end of this year.
hold
I
them
do
up
not
there.
expect them, and I have not expected them.
They can stay
what
above
I would
the
say, and
zero
I
line.
have been saying, is that I expect progress to be made in the second half of this year, mainly. Progress, because we're not making much progress. If you look at a ton of metrics, you can find some that suggest that delivery times are shorter and inventories in some industries moving up. But overall, we're not making progress.
We'll see you tomorrow.
And
Thanks,
things like
brother.
the semiconductor issue they're going to be quite a long time. I would think they'll go more than through 2023. In terms of being too late, I would just say this: our policy needs to be positioned to address the full range of plausible outcomes, as I said.
They wicked it.
And
Still
particularly the
down.
possibility that inflation will continue to run higher, more persistently than we'd expected. And we think we are positioned to make the changes in our policy to do that, and we're committed to doing that. And that's really where we are. In terms of your question about the size of rate increases, we haven't faced those decisions. We haven't made them. It isn't possible to sit down here today and tell you with any confidence what the precise path will be. But as we work our way through this meeting by meeting, we are aware that this is a very different expansion, as I've said a couple times, with higher inflation, higher growth, a much stronger economy. And I think those differences are likely to be reflected in the policy that we implement.
Thank you. Let's go to Mike McKee.
Thank you, Mr. Chairman. I'd like to sort of weave some of the strands of your answers together and ask you, as you start to reverse policy, what your goal is. Are you going to be raising interest rates until you get inflation?
All right,
to
feels
2%?
like the market's starting to
Do you want to
hammer
go
out a
below
bottom here.
2% so that on average you
Not
get
quite
a
neutral
2%
yet, but
inflation
it's
rate?
starting to get me there.
And because you said we have to protect the employment part of your mandate, is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the ultimate goal, and we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. And if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that. What was the last part of your question?
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022, and that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. Ideally, what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that accomplishes that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse, in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time is high inflation. And also, high inflation is taking away the benefits of some of these large wage increases that we're seeing now. So we do hope to achieve, and our plan is to achieve both of those goals.
If I could follow up, does the danger of tightening too much as policy works its way into the economy with a lag mean that you should go back to being more forecast dependent in making decisions rather than the state dependency you've been using as a framework for the last year and a half or so?
State dependency was particularly around the thought that if we saw a very strong labor market, we would wait to see actual inflation before we tightened. And so that was a very state-dependent thought, because for a long time we'd been tightening on the expectation of high inflation, which never appeared. And that was the case for a number of years. So in this particular situation, we will be clearly monitoring incoming data as well as the evolving outlook.
Let's go to Michael Derby.
Thank you for taking my question. I want to ask you, with the benefit of hindsight, and I realize, that is what it is, but do you feel that monetary policy and fiscal policy maybe did too much to react to the crisis, and that part of the inflation problem that we're having right now is because the government response, collectively was more than what the economy ended up needing?
So I think it's too soon to write that history, really. But what I would say is this. If you remember what it felt like at the beginning of the pandemic, literally the global economy shutting down in large part, including our own economy, and people going to their homes for weeks on end in masks, and there are no vaccines, and it could be a really long time to get them, and then you have economic activity drops by a shocking amount in one quarter. So there was a real risk of lasting damage. And I think Congress responded remarkably with the CARES Act, incredibly timely, very.
All right, so we got some resistance there. Looks like we need another push lower. I'd say 94-ish is a good area to look for support, 90 to 94 on the next push lower.
Because we've put so much support behind the recovery. And we're managing the relatively high-class problems that come with that, which are high inflation and a labor shortage. So, and these are serious problems, very serious problems that we're working as hard as we can on. Was it too much? Again, I'm going to leave that to the historians. But look, in 25 years, we'll look back at this incident, which will be a 2, 3, 4, 5-year period, and we'll say, we'll have a much better basis to make a judgment about the actions that people took. But it was all founded, though, in a very strong reaction to a unique historical event. And I guess I'll have to leave it at that. I hope I'll be around to see how that looks in 25 years.
Fair enough. Thank you.
Thank you. Let's go to Jean Young.
Thanks, Michelle. Chair Powell, some investors are expecting the yield curve could flatten or even invert after rate hikes begin. Would that worry you? And how important is that risk in the Fed's consideration for adjusting policy?
So we do monitor the slope of the yield curve, but we don't control the slope of the yield curve. Many factors influence longer-term interest rates. But it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many other financial conditions as we try to assess the implications of all those conditions for the economic outlook. So that's one thing I would say. Another is currently you've got a slope, if you think about 2s to 10s, two-year Treasury to 10-year Treasury, I think that's around 75 basis points. That's well within the range of a normal yield curve slope. So it's something we're monitoring. We don't think of it as, I don't think of it as some kind of an iron law, but we do look at it and try to understand the implications and what it's telling us. But it's one of many things that we monitor.
Can I follow up real quick and ask, if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time.
Thank you. Let's go to Brian Chung for the last question.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Within the context of just the broad effort to normalize rates, would you describe what you want to do as a gradual hiking? And then secondly,
other people got
within the
books. This dude
context
got his
of hiking
sneakers in the
cycles,
background.
it's often the talking point
Look at the
for
one on
financial
display under the
stability and
plant.
wanting to make sure that asset
guy's
bubbles
obsessed.
don't merge. Is that something that has also factored into the conversation as you start to think about hiking rates? Thanks.
I would describe what we're doing along these lines. This is going to be a year in which we move steadily away from the very highly accommodative monetary policy that we put in place to deal with the economic effects of the pandemic. And that's going to involve a number of things. It's going to involve, and it does involve, finishing asset purchases. It's going to involve lifting off, and it's going to involve additional rate increases as appropriate. And we're going to write down in March our next assessment of what that might be. It's going to continue to evolve as the data evolve. We need to be quite adaptable, I think, in our understanding of this. The last thing we're going to do is we're going to have a couple more meetings, I think, to talk about allowing the balance sheet to begin to run off and do so in a predictable manner. And that's something that we will also be doing as appropriate. And I wouldn't, I don't think it's possible to say exactly how this is going to go, and we're going to need to be, as I've mentioned, nimble about this. And the economy is quite different this time. I've said this several times now. The economy is quite different. It's stronger. Inflation is higher. The labor market is much stronger than it was, and growth is above trend even this year, let alone last year. So all of those things are going to go into our thinking as we make monetary policy. And you asked about financials to have concerns. In connection with our policy? Was that your question?
Yeah, within the context of other hiking cycles, it seems like worries about asset bubbles emerging as a result of easy rates has been part of that. I didn't know if that was part of the discussion today.
I would just say this. We of course, have a financial stability framework. And what it shows is a number of positive aspects of financial stability, but you mentioned really asset prices is one of the four. So asset prices are somewhat elevated, and they reflect a high risk appetite and that sort of thing. I don't really think asset prices themselves represent a significant threat to financial stability, and that's because households are in good shape financially than they have been. Businesses are in good shape financially. Defaults on business loans are low and that kind of thing. The banks are highly capitalized with high liquidity and quite resilient and strong. There are some concerns in the non-bank financial sector still around money market funds, although the SEC has made some very positive proposals there. And we also saw some things in the Treasury market during the acute phase of the crisis, which we're looking at ways to address. But overall, the financial stability vulnerabilities are manageable, I would say.
Thank you very much.
Thank you.
All right. Peace out, Papa Pal. So is it just me, or did he basically just over and over again basically say, we don't know? Like he's like, we're going to have to be very nimble. We're going to be nimble. We've never seen this before. We'll be nimble. We're just going to be really nimble, guys. We're so nimble. All right. Well, we did push right into that first level, that POC from the 24th that I thought could act as some potential support, and it is working there. I do think we're hammering out a bottom here. We haven't found it yet, but I think we're on our way. It is worth mentioning, whenever you see a massive sell-off like this, and it has this very thin white volume the whole way down, as we have on here, that is often a sign that the selling that took place, that got the market from here to here, was very emotional, and emotional selling very commonly retraces quickly. So if we don't retrace back up to the value area within the regular trading hours, or I guess that's in the next 30 minutes, so I don't know that we'll make it by then, I bet we will in the overnight. We'll at least come back up in here and test this, because this volume is so very thin. It's just a sign that it was emotional selling. And humans and their emotions, not good for trading. So remember, we do have a target to backfill these single prints to the C period low. So if we can reverse the momentum here, which we're doing, that would be the target to the upside, 43.80. Exciting times. That's sympathetic. Our mandate is, well, our mandate too, and like I said, our mandate. Yeah, there was so much word salad in that. All right, so some people had some questions during the live stream that I couldn't get to. Somebody asked what the chart is. This is a market profile chart. It's the same as a regular candlestick chart over here. Each letter represents a 30-minute time period, and it just allows me to look at the market in 3 dimensions, right? If you look over here at this SPX chart, all it's really showing you, if you had volume in it as well, it would show you how much volume traded within each 30-minute, but not at what levels it traded. And as you saw today, as the market was selling lower, where did we find support? The first support was right there. Major node of volume, major node of time. Where was the next support? Right in here. Major node of volume, major node of time, right? And then the last support was right down here, which is the current support. Major node of volume, major node of time. So that is the advantage to the market profile software, is it lets you see the market in a way that you just can't visually see it here. But it's the same data. It's the same information. Hey, got our first pink candle down here in the liquidation. Let's go look at those ticks. Up, they're above the 0 line. So that increases the odds we are going to backfill those single prints at some point here to the upside. Ooh, another set of single prints here in the M period. So we have a fun little game we like to play here at Pirate Traders when we get to the M period, and we've only got a half an hour left in the day. People in the chat like to throw out their ideas for where they think the market is going to close at 4 o'clock, 4 Eastern. So let's do it. What do you think? Where is the market going to go? All right, the market's starting to backfill this first set of single prints left behind from the L period. We'll look for resistance right there at the K period low. If we don't get resistance, the next stop will be backfilling the K period single prints. So we got John L calling for 43.75. So he's looking for that push higher to backfill those single prints. S&P addict 42.24. So he thinks we're just kind of, oh no, he thinks we're going to tank 42.24. You think we're getting that spike down. Yeah, that would be a big spike. I'll have to wait and see. Cyrus 43.79. So another person looking to get up to the base of those single prints. MK 43.80. I should not have said that. I have to remember to not tell people what I think is going to happen before I take the guesses, because you're all guessing that we backfill those single prints. Orion Trading is seeing 42.66. So another person looking for that big spike down today. All right, let's see what happens. Diane, 43.85. Also thinking we get back up into range. Boy, isn't it interesting how much volatility there was the whole time he was talking, and the second they cut out, it just stopped. So interesting. It's bots, man. Futures trader, see him 44.10. So he's looking for a big push higher up towards the POC. Mixed Stockster is seeing the ES at 43.04. So he's looking for a little push lower. And he says on the dot, that's the exact level at exactly 4 Eastern. Gotcha. S&P addict making a slight adjustment, 42.88. Still pretty bearish. Still looking for a spike. Actually, that's not too bad. That's doable. Nicholas, 43.85. Okay, another push higher. C, 43.80. Another person looking for a push higher. Sanju 88. Mark 99. All right. Yep, back up into range. Chris 4,300. So thinks we're going to close down here at the lows. S&P has he's decided we're going lower. Just wanted to let you all know. S&P made his decision. We're going lower. Chitin seller at 43.40. Yeah, it was definitely a one-person deal with that big candle right there. But we know what happens if they get on the other side of that. A squeeze. Boop. How's the NQ doing? Let's take a look. I mean, it's just been moving so in sync with the ES for the last couple days. It's pretty much like watching the same market, just this one has more volatility. So same thing, 2 sets of single prints, a single print in the L period that still needs backfilling, and then the single prints in the K period. Not as much support below, though, as the ES. Amir 4,200, another bear in the house. Cyrus, how late do I accept guesses? Well, pretty much now. I mean, you'd be making a guess 10 minutes before. That doesn't count. It's now or never. Be right or wrong. Public humiliation. If you're wrong. Damn, that audience fell off. I should not have started singing. Aaron, 4320. All right, I'm going to step away for a moment. I'll be right back. Diego coming in at 42.58, another bear. We got a nice diverse group today. Half think up, half think down. Only a couple of you think we're staying here. Diego, going to 42.58, but we have to go under 42.87 first. That is a accurate assessment? I'm just kidding. Oh, somebody else had asked during the stream what the screen with the Thinkorswim is. This is what we call the market internals. So over here on the top left, that's what it's called, the breadth of the market. The middle one is called the advancers versus decliners. The bottom left is the ticks for the NYSE. And then the middle bottom is the ticks for the NASDAQ. And basically all four of those are just kind of showing us under the hood of the market, right? This one's measuring volume up versus volume down. This is measuring number of stocks up versus number of stocks down. This one's measuring bids versus asks. So it's all kind of just showing you the same information, but from kind of slightly different angles. And then over here on the right, I keep the SPX chart and the NDX chart. And the reason I have these here specifically is because they only use the regular trading hours. They don't include the overnight. If I had a futures contract, it would include the overnight. So I very specifically only want the regular trading hours. And then I put a simple 20 moving average on it, this little white moving average you see here. And this is very, very commonly support and resistance intraday. So those are kind of what I'm constantly clicking back and looking at. I will tell you 90% of the time when you see me click on this screen, I'm looking at this one down here. This is the real winner because it shows me the ticks in the NYSE as they're happening in real time. Winner, winner, chicken dinner. All right, my vote is still for a spike up to backfill some of these single prints here in the M period. J Trader, was this a record number viewing? No, not at all. Back in the day before I started the brigade, when I was live streaming all day, every day, by the end of the day, by this time, I'd have like 300 people watching. But, you know, YouTube got mad at me because I stopped doing it. I would love it if we could get to 90 likes. You know, 90 people watching, 90 likes. That would be cool. Are there 11 people out there who haven't pushed that thumbs up yet? Go for it, man. Give it a try. It's so much fun. Cyrus, subscriber number keeps ticking up day by day, very, very slowly. That's another thing that slowed down exponentially when I started the brigade. The growth of subscribers. I got from like 500 to 1,000 in like 2 months. And it's been like 5 or 6 months since then, and I've only gotten another 500. So yeah, that slowed down too. The algorithm is king. Hey, we made it. So we didn't bring in the extra likes, but we did just get rid of some viewers. Gorgeous. The NC ticks is for the S&P 500 or NASDAQ. Well, there's some stocks that are in the S&P 500 in both, you know. But yeah, generally, like, I look at the NASDAQ tick specifically for, you know, what I'm looking at in the NASDAQ. And I kind of treat the NYSE as if it's the S&P, but really they both affect the S&P. But yeah, that's why I prioritize this one. With yellow color. Are you asking about the volume profile over here on the left? Yeah, so if you look at the nodes over here within each individual profile, that is the volume within that day, right? And then over here on the left side of the screen where you see the yellowish goldish, that is the volume for the composite for like the last 60 days. So you can see in the areas where we had a lot more trade, you can clearly see those nodes. So yeah, that's just combining all the volume together. Okay, so once again, as we push up into that 43.49 level to fill those single prints, we'd be looking for some resistance there at the K period low. Right there. For those of you that are new to the stream, we've observed that in the last 10 minutes of the day, there is often a random spike of volume and volatility that kicks in right at 350 and then right at 355. There's two sets. It is obviously algorithms, and it's about rebalancing the market, taking the trade that took place over the counter during the day and putting it into the books. So it often causes these little spikes of movement up or down very quickly in the very last 10 minutes of the day. And it is completely unpredictable. We've been trying to figure out a way to know what the murder bot's going to do. And we never know. Anyway, that's why we call it the murder bot. So the murder bot will be kicking in 1 minute. Dun, 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 dun. Corey, first time seeing a chart that looks like this. It looks like the Matrix. Well, I can read it like the Matrix, too. All I see is a blonde and a brunette and a redhead. You remember that line? Yeah, it's basically just taking the same information as the regular candlesticks and just displaying it three-dimensionally. It's called a market profile chart. All right, that's the murder bot. Let's see if we get a spike somewhere. Do you guys see how the tempo instantly picked up? Got real fast? That's those algorithms kicking in. Rocket in the house. Good to see you, brother. We've had a 3-day murder bot. It has felt like that. The murder bot that never quits. RK, you think Papa should just raise the interest rates and call it a day? let the markets fall into chaos. All right. Well, so far this is what we would call a murder knot because we're not going anywhere. But there is one more wave to kick in at 355, so we'll see if that gives us some momentum. Big Ray, can we do this again tomorrow? Big day for me. Good for you, brother. You earned it, man. You had to work for that day. Okay, so if the market were to close right where it is right now, the way I would look at it on a longer term basis is I would assume that we've begun to create what is called a balancing area. And a balancing area is an area where the market bounces in between over and over while it just kind of balances. So I was talking about earlier this morning, we needed to make a low to see if we could figure out where the lower end of balance is. And so right now, I think it's one of two options. We're either channeling, we're beginning to start to channel like this, up and to the right, or we're balancing horizontal. And I would use this area like 44.24 as a balance area high. And then I would call this area right down here, balancing area low. And so the idea is, if I'm correct, tomorrow we should head up to test the balancing area high. But we will have to wait and see. Balance is a way for the market to stop momentum. So the trend has been to the downside. So now spending a few days bouncing around in a range sets us up to either get further continuation or to start that recovery. We've got 3 days in a row of higher lows, 3 days in a row of the value area. Sorry, this is getting messy. 3 days in a row of the value area being overlapping to higher, or today it was completely higher. So to me, I think we're hammering out a low on the larger time frame here. So I'm looking for rotation inside this balancing area and then a breakout, which there's like a 60-40. 60% it breaks to the upside, 40 to the down. I'm pulling those numbers out of my butt, but they seem right. Lazy eye, 2-minute delay. Well, you're not going to hear me say this for another couple minutes, but yeah, that makes sense. I had so much stuff running on the internet during that stream. All these charts and the video uploading, and the video downloading through YouTube, and it's all uploading at the same time. So that would have caused a delay. All right, muchachos, that's it. What a cool day. The market did exactly what we thought it was going to do. It stayed ranged bound, and then it picked a direction initially on the FOMC, and then reversed the opposite direction for a massive sell-off. That was literally textbook what we were looking for. We didn't know if it was going to go up or down, but we were looking for the counter move. So sweet. Thank you all so much for joining me. I look forward to seeing you right here tomorrow morning for the market open. Thanks a lot, guys. Have a great rest of your day.